We continue to see exponential growth in the space, both from investor appetite and demand for the product overall, but also the TAM itself continues to grow. And I think that's probably been the most surprising element of it is just the pure growth of alternatives overall. Most traditional private equity funds are raised at what we call 10 plus 2. And that's a 10-year term with 2 one-year extensions for assets that ultimately many times have durations that far outlast, especially if they're been acquired later in that investment term in the 4th or 5th year of the said life cycle of the given fund itself. Piper Sandler, they've identified over 30,000 different private equity owned businesses that are over 5 years on their hold currently within the US alone. And so as assets have increased under management, more than 50% of the assets held out there are greater than 5-year hold periods. And so that begs the question of how do you achieve liquidity and returns in ways that aren't outright sell side situations that are returning distributions? And so while the continuation fund, let's just call it 5-6 years old in its current format, it's gone through different machinations over time. We're in early innings in terms of all the different structures and capital that will have to come into the system in order for all these assets to achieve distributions, find new owners, et cetera.
Basically, the rigid structure of private equity fund, it's a structural flaw.